I follow the VTS portfolio and will be off grid with no internet for a month from mid-February to mid-March. What do you recommend for someone who won't be able to cycle in and out of positions for an extended period? So I like this question as well. One of the reasons is I get to highlight one of my pet peeves in the industry. Let me know if this chart here reminds you of something. Essentially what it is, start with $10,000, you invest in the S&P 500. This is a 40-year time horizon. If you invest in all days, basically buy and hold, and there's a million variations of this. Financial advisors love this chart. They love flashing this chart. But if you miss just 5 of the best days in the S&P 500, you lose 40% of your money, right? If you miss the best 10 days, you're down over half your money. And so the reason they like to flash these charts, imagine what's happening when you get a crisis. Clients are losing money hand over fist, right? They're down 20, 30, 40%. Everybody's panicking. They want to leave, but the financial advisor doesn't get paid if you leave. So you have to stay. Well, how do they get you to stay? They tell you, hang on, the market could recover here. And if you miss just 5 good days, you could lose half your money. And it actually kind of makes sense for people. And they're like, yeah, I can see the data there. I don't want to miss the best 5 days. What if it recovers? The problem, of course, is that you're ultra cherry picking, like the 5 best days. Even if it does recover, there's going to be down days in that as well. You're not missing the 5 best days. You might be missing 5% or 10% of a recovery. It really doesn't matter. And I'm going to show you exactly why it doesn't matter. So the first thing that I will say, though, the straight up answer is you need to go to cash, enjoy your vacation. That's what you do. But I can actually show you how insignificant this is. So this is a compound interest calculator. Person starts with 25 grand. They make 12% a year. Very ambitious for buy and hold people. Typically, I say about 7. But again, our portfolio is about 22. So let's split somewhere near there and just say 12%. 25% capital gains, and you add 1,000. This person at the end of 30 years has $1.73 million. This person is going to do the exact same 4 inputs. And this person also has the exact same amount of money. So you can see no difference between these two people. Well, what happens if this person skips a little bit of this performance? How much of a difference is that really going to make? So what I've got here is all the performance of VTS. We've been going for over 11 years now. This is the monthly distribution. You can see the 50th percentile is 1.97% a month. It's basically on an average month, that's what we're making, just under 2% a month. So we are actually coming off a really good month in January. We were up over 5%. So there might be some diminishing returns. It's probably not expecting an above median. So let's go ahead and use that middle number. I mean, it's certainly possible that, February to March is just a killer period and it might be 3 or 4%, but let's see what happens if you just skip 2 of these, all right? So we're going to update this chart and you let me know if that is devastating. I've already updated it. So that's the difference. Can't even see the blue line behind there. Essentially the difference, you're going to lose $3,000. So instead of being at 1.733 million, like this person, you would be at 1.73 million. You lose 0.16% of your portfolio. That is a long ways away from what they're telling you. If you skip the best 10 days and cherry pick the ultra, over a 40-year period, you pull out the best 10 days. Obviously, that's going to be an insane difference in performance. But we're not talking about pulling out the 5 best or 10 best. We're talking about skipping a month. Skip 2 months. Skip this. What difference does that really make long term? Not a whole lot. I can kind of start to see a blue line there. Now you're going to lose $12,000, still less than 1% of your portfolio. Let's make it really crazy. VTS is obviously profitable, so I wouldn't want you skipping too much of the performance. But let's say you decided for some reason you're going to skip what would be equivalent of a year. You're still going to have $1.69 million. Yeah, you lost 40 grand, and yes, you're slightly dipping below. But it's really about finding something that works long term and being consistent with it. And like I said, the power of our portfolio is how nimble we can be. And we can cycle out into a way better portfolio on Monday than we are on Friday if it's crashing. So move to cash, enjoy your vacation, no problem. I don't need to basically lie or heavily lean on you and coerce you into staying. It's fine. You want to take a month off, you take a month off. It's, even if you get extremely unlucky and February happens to be the best month I've had in years, it might cost you 1% of your long term. It's not going to be like that chart was showing, like you're going to be alarming. You're going to lose half your money if you do this. It's not at all. Being off grid is fine, but absolutely go to cash because you have to be there to cycle out if something terrible happens. You never know. So for an extensive volatility metrics dashboard updated daily and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.